So you own an asset like a stock or investment property that's appreciated or it's gone up in value. It's got gains. That's great, right? And you decide you want to capture those gains. You want to take those gains, put them in your pocket. So you're going to sell the asset. Well, don't forget, you could owe the IRS on those gains. That's capital gains taxes. And depending on how you handle it can impact how much you owe the IRS. Really understanding this topic, you can help use it to your benefit and help keep more of those gains with you. Today, we're going to discuss the capital gains taxes, and stick around to the end. I'm going to talk about 5 strategies that we discuss with our clients to help avoid or reduce the capital gains taxes. I'm Scott with Sierens Financial Group, where we help people with their key questions. Are you on track for retirement? What can you do to potentially improve your financial picture? And then how can you help reduce your overall tax situation? So today we're going to talk about capital gains taxes. First, we're going to talk about what's considered an asset that you may have to pay capital gains tax on, short-term gains versus long-term capital gains tax rates. And then I'm going to end with 5 strategies, again, to potentially avoid or help reduce your capital gains taxes. So let's dive in. First off, I mentioned that you own an asset that's appreciated in value. Well, what's considered an asset? You might have a stock, a bond, a mutual fund, an exchange traded fund. Those items being in non-retirement accounts. So a stock, mutual fund, or ETF, exchange traded fund, in a non-retirement account. Or it could be land, property. It could be your current or primary residence. Maybe you own a business. Any of these items that I've listed here that you could own and could go up or down in value. So let's just say you own an asset. You know that you have gains, but you haven't sold it yet. Well, that's okay. There's nothing at that point in time. There's nothing, if you haven't sold it yet, that you have to claim. And that's what is considered unrealized gains. But let's just say you do decide to sell your asset. Well, once you decide to sell, then the gains become realized. And you have to claim realized gains in the year that you sell. That's the year that you have to claim them on your taxes. Now, you may owe taxes on the gains, and the tax situation's all going to depend on when you bought compared to when you sold. So again, you own an asset, you've decided to sell it, you now have realized gains on that asset. How you will get taxed depends based on when you bought versus when you sold. So you could be looking at the short-term capital gains rate or the long-term capital gains rate. Let's start with short-term capital gains rate. If you own an asset, again, you had gains and you sold it in 1 year or less from when you purchased it, those gains would be considered short-term gains. And the rate that you're going to pay on those gains is ordinary income tax rate. Now, let's just say instead you held the asset for 1 year. You held the asset for over 1 year before you decided to sell it. Well, now those gains would fall into the long-term capital gains rate. And the tax on these gains, as you can see from the chart here, are more beneficial. You could be looking at 0%, 15%, or 20%. And this all depends on the taxable income for the year that you made that sell. Now, a few, I'll say, caveats on this. If you have collectible assets like coins, precious metals, stamp collections, fine art, or antiques, tax rate on those gains is 28%. Also, something to be aware of for high income earners is that you might also owe the net investment income tax. Again, it's a tax that high income earners should be aware of. And that's an additional tax on top of the capital gains tax here of 3.8%. So how about this? Let's just walk through an example. Let's say you bought a stock. And again, you can put in whatever you want for your own example here. Maybe it's a mutual fund or an exchange traded fund or an investment property. But let's just say that you have a stock, and again, in a non-retirement account, And let's say the current value of that stock is $15,000. Now, what you paid for the stock, or the basis is what they call this, was $5,000. That means that you've got $10,000 in gains on that stock. So let's say you decide to sell the stock. Well, you decide to sell, and then in the year that you decided to sell the stock, your taxable income, and I'm just using an example here, let's just say you're married filing jointly, the taxable income for that year was $80,000. Again, based upon how long you waited to sell that stock will help determine how much you're going to pay in gains or pay in tax on your $10,000 in gains. So let's just say you sold that stock in 1 year or less from when you purchased it. Well, based on the 2021 tax rates for married filing jointly, again, since it's 1 year or less, you're looking at short-term gains tax rate. Based on that taxable income, it would be a 12% tax rate. That means out of those $10,000 of gains, you're going to have to pay $1,200 in taxes. But let's just say you held on to that stock for more than 1 year before you decided to sell it. Well, in that case, again, based on the 2021 tax rates, you would actually be looking at the 0% long-term capital gains rate, meaning you would not owe any tax on the gains from that scenario or that example. No taxes owed. So again, it depends on your income, it depends on the gains, and this could all change if Congress were to decide to change any of the tax rates. But the point is that it's important to pay attention to this, right? You could be looking at a $1,200 tax bill versus a $0 tax bill. So let's talk about the 5 strategies that you can utilize to help avoid or potentially reduce the tax rate that you're paying on the gains in your account. But first, before I get into that, I hope that you're finding value and benefit from this video. And if so, and you'd like to see additional videos just like this to help you build wealth and reduce your long-term tax picture, subscribe to our YouTube channel by hitting that red subscribe button below the video, or connect with us on Facebook. That way you'll get notified as we continue to come out with additional videos just like this. All right, let's talk about the 5 strategies to help you potentially avoid or reduce the capital gains tax. Here we go. Now, before I dive into the first one here, I also want to talk about you could have losses on an asset. And if you have losses, those are considered capital losses. Now, we'll have to do a whole separate video on that, but just so you know that you can utilize capital losses to offset capital gains. But again, that's a whole separate subject, and we'll have a whole nother video on that. So how can you minimize, let's just say you only had gains. What are some strategies that you can use to potentially avoid or minimize the taxes that you would pay on your gains, helping keep more of your gains in your pocket? Well, the first one, as I just showed you there, was that you can hold on to your asset for greater than 1 year before you decide to sell it. By doing that, you're looking at the more beneficial tax rates of the long-term capital gains rates. Number 2, if it's a property, you can make this property your primary residence. And by doing so, let's just say you make the property your primary residence for 2 out of 5 years before you decide to sell it. Well, by doing that, let's just say you had gains on that property that was your primary residence. Those that are single can exclude up to $250,000 of gains, and those that are married can exclude up to $500,000 of gains. But again, you must live in it in 2 of the 5 years prior to selling it. All right, our next strategy is utilizing tax-advantaged accounts. What do I mean here? Well, you could utilize an IRA or a 401k, meaning that by putting money into these accounts, they're considered tax-deferred accounts. You are now deferring all your taxes until a later date. However, all of the withdrawals on these types of accounts, right, you will be paying your ordinary income tax rate. So the other types of accounts you may want to look at are Roth 401k or Roth IRA. Now you will pay tax on the money that you put into those accounts, but the money that you've put into a Roth 401k or Roth IRA, plus all of the gains or the growth in those accounts, is all growing tax-free. Plus, you can make withdrawals again from your base or all the gains on those accounts tax-free as well. Our next strategy, number 4, is using tax-efficient funds. And we could do a whole separate video on this, but you may want to consider utilizing ETFs, exchange-traded funds, in your non-retirement accounts instead of using mutual funds. Again, there are some tax efficiencies to these types of funds that can help your overall tax picture. And then the last item is timing. And you might say, well, timing, you already told me to hold on to, for 1 year before I sold. But the other part of timing is not only just holding on for more than 1 year before you sell, is understanding your future income. And if you know that you might have a year of reduced income, meaning retirement, utilizing those years of reduced income to then capture or realize the gains in your non-retirement accounts or maybe in your investment properties or other assets. So 5 different strategies here that can help you potentially reduce or avoid the capital gains tax on gains that you might have on your assets. For those of you that are, doing trading on your own, I bring this up because I want you to be aware of the tax liabilities that you might be creating if you're doing a lot of buying and selling. As you can see, for everyone here, tax planning is really important. When you decide to buy and sell, can help you realize your gains at potentially a more efficient rate. Understanding this topic and working with an advisor like our firm that has a tax planning focus can really help keep more of your gains with you and in your pocket versus turning them over to the IRS. I really hope you enjoyed this video. And again, if you'd like to see additional videos just like this to help you build wealth and reduce your long-term tax picture, subscribe to our YouTube channel, connect with us on Facebook. That way you'll get notified as we continue to come out with additional videos just like this. Thanks and have a great day.